Okay, you can get started.
Awesome. Thanks, everyone. Good evening, and thank you so much for joining us this evening for a 60-minute session with some of India's best early stage investors. Before we start, just want to give a huge note of thanks and gratitude to all our frontline workers, our healthcare workers, and everybody out there who's literally, braving it out for all of us to stay safe. And I sincerely hope that each of you, as well as your families, your near and dear ones, are safe and secure, no matter where you're joining us from today. So today we have with us Tushar from Dexter Angels. We have Vinay Bansal from Inflection Point and Pearl Agarwal from Eximius. And these aren't like randomly selected investors. I would say the four of us, in fact, have come together to partner and create a one-of-a-kind program called the Fast Forward program. And without much more ado, I'll allow each of them to introduce themselves, their funds, their areas and sectors of interest and focus. And then we'll then proceed to having a Q&A session. So I encourage each of you to just start typing in any questions that you may have for this panel into the Q&A chat box. One request is not to DM me. It's just easier to handle just one Q&A section. So do start typing in your questions there, and we will try to answer as many of them as possible. And we'll also discuss some stories of resilience from each of our portfolios of founders that have done incredibly well despite the macro situation of raising, surviving, pivoting, through these challenging times. And we'll also have an overall chat on what's currently keeping each of us busy and excited about the early stage ecosystem. So I'm just going to go in the order in which you appear on my screen. So Tushar at Dexter Angels, over to you, and would love to learn a little bit about your own story, about how Dexter Angels comes together, and over to you, Tushar.
Thank you so much, Anjali. So a pleasure to be on this panel. So guys, to give you a little bit brief on Dexter Angels, we are the angel syndicate. We invest in startups which are pre-seed, seed, and in pre-series A stages. We have been fairly active from last 2 years and have built a portfolio of 8 to 9 companies. Typically, these segments which sorts of excites us today are, SME digitization, creator economy, SaaS companies being built in India for the world. And of course, the regular sectors like digitization of education, fintech, API companies. So yeah, that is those are the sectors which sorts of excites us. We are fairly, in terms of philosophy, we are fairly focused on finding the right founders who are aligned with our thought process. And we also tend to believe that we are very board light kind of investors. So we really don't bother to have board seats, but we like to be friends of the entrepreneurs whom we work with. Yeah, so that is in brief about Dexter and our thought process.
Awesome. We'll come back to you in a little while about some questions around your philosophies and your construct. Vinay, over to you, and would love to learn a little bit more about Inflection Point.
Sure, Anjali. I think before I go to Inflection, a little bit about philosophy, I guess, and how it got developed over a period of time. I started my career with Unilever and then worked for GE about 15 years globally. And then, of course, I worked with startups like Wildcraft, very early days, helped it scale up. Then I worked with large private equity funds like TPG before setting up Inflection Point Ventures. The career shift, or where we started thinking about Inflection Point, was about 2014. And the idea was I had spent a lot of deep time in working with very large companies, building processes, building companies, and even turning around large operations. And then I realized, what I want to do later. And that's when I spent some time. I realized that a good entrepreneur and a good investor cannot be just sitting on one side of the table, which means if I had worked in large companies, then I just could not become a great investor just by sitting there. I had to spend time in startups myself to understand that side, and then also have a good financial understanding. So that's exactly what I did. I went in, worked with startups like Wildcraft in their shoes, and then I worked with investors in their shoes like TPG, before setting it up. So kind of a very well-rounded experience to bring both investing mindset as well as the business running mindset to the table. And that's exactly what we do at Inflection Point Ventures. We are about 5,000 CXOs who have come together to start Inflection Point Ventures, and we invest together. We have a portfolio of about 70 companies today. Out of 70, about 35 got invested in the last 9 months. And out of 35 that were invested pre 9 months, about 17 have seen either the follow-on round or an exit. About 6 exits at about 200% IRR average. And the other, I would say 11 are above 100% IRR, unrealized. So 17 out of 35 are at that level already, other 17 doing well, other 18 doing well. So that's been our premise of setting up IPV. We back great founders, we back great businesses, and we do very deep due diligence and support the founders in helping achieve the dream.
Awesome. Thank you so much. And, Pearl, over to you. But before you start, I think just want to let the audience know that we will spend a little bit more time understanding the way each of us are structured at the back end, and to help you understand the fine differences between syndicates, between funds, between angels. And the second part of the session is, in fact, about the value-add construct. So just hold on to your thoughts in Q&A, and we'll come back to that. Pearl, over to you.
Yeah. Thank you, Anjali. So, I'll tell you guys a little bit more about myself before jumping into Eximius and how Eximius is set up. So just to give you a little more introduction about myself, I've spent the last decade across US and UK working in various financial services companies. So started my career at an endowment fund where I was working across 200 plus venture capital funds and private equity funds. Then moved to investment banking in Merrill Lynch. And then post that moved to a large private equity fund, which is a $70 billion private equity fund based out of New York, where I was helping out with large multi-billion-dollar transactions, but also through our preferred equity fund doing smaller $5 to $10 million transactions. So spent a few years in the New York office and then moved to the London office to work more on European and Asian Pacific portfolio investments. And during that time, I was also following what was happening in India very closely. And the last decade has been very instrumental for us, where a lot of new startups have come up. There has been quite a bit of activity here. So during that time, I sort of realized that this is the next thing that I would want to do. So moved back to India in 2020, early 2020, when we started thinking about Eximius and setting it up. But while I was doing that, also wanted to sort of get my hands dirty. So began doing angel investments. In the last 1 year, I've managed to do about 10 angel investments, primarily in fintech, gaming, and edtech company. I know Vinay and I shared one investment in gaming together. In addition to that, also started to help out a few startups more in a consulting role. So, there was a neobank that came my way that was setting up for the NRI population. So got involved with customer acquisition and growth strategy. And similarly, sort of got my hands dirty with a few more gigs in startups. During this time, we decided that we would want to sort of set up a small $10 million fund, Eximius, which is a micro VC fund. Very recently, we've had the first close. And the idea is that going forward, we would have about 25 to 30 investments. The ideal check size would be anywhere between 150,000 USD to 300,000 USD. And our sector of interest remains, edtech, fintech, gaming, as well as digitization of SMBs. However, having said that, more than sector focus or sector driven, we are more investment thesis driven, where we do a lot of groundwork, develop thesis, and then work with companies that fit that. So that's a little bit about me, glad to be here and speaking with everybody.
Awesome, great. So we'll just circle back to you, Tushar, and since today's topic is really about the value add construct and the fact that the color of money is not all the same. I think a first question, I know that Dexter's structured as an angel syndicate, and one question I'm sure a lot of founders always have is, what's the difference between angels and angel syndicates? I know the tempting short form answer is that investors cannot be part-time, and it's better to have a syndicate, but just help the audience today understand the subtle differences between the two.
Yeah. So I'll categorize this into two, right? So there are angel syndicates and angel networks. There's a subtle difference between the operation of the two. So typically, an angel syndicate is an entity where there is a lead who's focusing a lot on doing the due diligence and then sharing the companies which they like with their investors, right? So there, at the back end, there are a group of investors who trust the lead to do the right thing, and on the front end, the lead does the due diligence, evaluate these startups, and when find a certain opportunity where they want to invest, share it with their group of investors. So, uh, and other subtle difference between angel networks and syndicates is that syndicates typically enter as a single entity on the cap table. So sometimes it becomes operationally easy to sort of manage syndicates than, let's say, managing networks from the founder's perspective. On the other hand, the angel network model would be typically all the individuals coming in together, not so dependent on the lead to take the right decision, but a lot more dependent on their own ability to judge, and then sort of coming in individually on the cap table. I think that's primarily the difference. Overall, the what do you say? The thought process is almost similar, where each one is trying to find good companies to participate in and adding value to those companies by leveraging the power of their own networks.
Awesome, thanks. And as funds mostly and as institutional VCs, normally the LP structure and who backs us as LPs are not very publicly disclosed. But Vinay, you've built an extremely unique and one-of-a-kind industry model with Inflection Point, and you were mentioning early on in your introduction that this is over 5,000 industry leaders, sector experts, CXOs who have come together. So as a founder approaching Inflection Point, do they therefore get to pitch to a select few of them? And do you even kind of publicly list out who your backers are? Would be great to, like, if you could lend a little more color on these CXOs and professionals who come in to back founders.
Sure. See, CXOs were never thought to be HNIs who could, first find the time and then find the money to invest, right? What was very important to open up this market was to understand where CXOs come from. And we've been some of those ourselves. We've lived those lives. The insights are they don't have time, but they still want the best quality work because they're used to seeing the pitches inside the corporate offices, large teams pitching to them, quality of work that needs to happen, etc. And they do earn well, right? I mean, and they have the cash flows that come through even during pandemic times. Versus another HNI whose cash flows might get impacted. So they can go against the grain, to be honest, and they apply their own mind, right? So if you understand these four corners of a CXO and you build around this, then you've got the product market fit right. So what we did is we built a very deep due diligence teams. We brought in the wisdom of the crowds to help us do the due diligence and bring the right intelligence in. That allowed us to do even the sector agnostic investments, right? So we don't take time of a CXO more than 1 hour per investment. We don't take time of a founder of more than 2 to 3 hours per investment. So our founders don't have to talk to each and every CXO. CXOs also don't like it because they don't have that much time. And the third is we close investments within 4 to 5 weeks versus any other angel syndicate or a network, which will take sometimes 12 to 18 to 20 weeks also to close, or from the meeting the founder to funds in the bank is typically 5 to 6 weeks. This includes due diligence, this includes term sheet, this includes SHA, and the top class work that we do. Now, but for us, the investment is only about 10% of the time. 90% of the time goes after the investment in making them successful. And that is what I think we can spend a little bit more time on our processes to make it much more successful, which is visible in our results. And I think also kind of ties into the color of the money, conversation that we are having. Let me know if I answered your question. If anything more you want to ask, happy to answer in more detail as well.
Yeah, no, would love to just dive straight into that. So what I'm taking away is that it's a single pitch and, it's very efficient on founder time. and the CXOs, the backers who are interested, go ahead and fund you. But post investment is where you double down on the value add, and help us understand if you nominate somebody to serve on advisory boards, for example. Do you have a sector expert or one of these CXOs, maybe even be the IPV board nominee? But we could dive straight into that here.
Sure, happy to. So what happens with us is whenever we invest in any company, we go in with a thesis, and our thesis is a very balanced scorecard over 200 data points or 200 checklist points. And we have a scorecard. We actually give a score to every startup. After that, what we define during due diligence is, here are the 10 things the company is weak at, and here are the 40 things company is great at, and here are the 10 things that we can help the company grow, right? And then there is a standard set of benefits that come with IPV, which is, let's say, we have partnerships with about 100 VCs and private equity funds. We will be able to showcase to each one of them over the next 6 to 9 months, right? So funding. Then we have tie-ups like partnerships like a WaterBridge would have, let's say with AWS and others. So that comes anyway standard. Where we differentiate is, let's say, you have a company in IoT space which helps you track your material. Now we will be able to open doors with all the logistics companies in the country. We'll be able to open doors, let's say, with a company like a Myntra or an Amazon or a Flipkart, because all of these CXOs are there on the network, right? They will be able to quickly open the doors inside their company. That helps our portfolio companies to grow 5x, 10x in a year very, very quickly, right? And if these are B2B companies, great. Similarly, for B2C companies, we have a panel of about, I think, maybe about 70 experts across the country, and these are best of the best minds in the country on their topics. So we form an advisory panel of about 4 to 5 people per startup, at least. Sometimes it goes up to 10 also, and everybody picks up an area of work that they will help the startup with over the next 12 months. Now think about it. You have, let's say, 5 to 6 very sharp, selected, high brain power people working on one startup, giving them guidance on very sharp one area. Now you have a great advisory board to help the company grow. Few examples, like Bharat. Let me talk about a few first checks we cut, in the last 4 or 5 years, and where these are today. I'm just going to talk about the first checks, which is we cut the first check. BharatPay was one company where we cut the first check. We cut it at a $2.5 million valuation. And you all know early 2020, they raised their last round at $1 billion valuation, all in 2.5 years. How is that possible? It's not possible by a fluke. It is the kind of people that come together to help design, strategize, and say where the country is going. We are, out of maybe 5,000, about 2,000 are CFOs. They could actually tell BharatPay where to point, where to collect money, how the money moves, and how to think about it. So that is one example. Similarly, let's take a consumer example called Fitso. Again, we cut a first check at $1 million valuation in 2015. I'm a sportsman, I understand the industry, and the founders were an Ironman himself. So when we came together, we helped them with marketing, we helped them with funding, we helped them where to go to, and in the end, finding a right home during COVID period with Zomato. Again, more than a 10x or a 15x return for us, as even in a pandemic time. So that's how we add value. We have a quarterly board meeting review processes, which is not called a quarterly board meeting or a performance review. We call it SIP meetings. SIP stand for Startups and Investors Partnership Meetings. Half the time is dedicated by investors in answering questions of our founders, helping them grow, helping them connect, helping solve their problems. And the other half is when founders talk about where the business is, etc. And this is a non-negotiable process where all investors come together. It's a great collaborative effort. And I think one thought sparks another thought. People come together, they compete to help, and then the magic happens. So that's the model we apply here at IPV.
No, great. It's amazing you gave us example of BharatPay, and I'll use that as a segue towards Pearl. And I think, Pearl, we both can agree that most founders don't realize that raising a fund, with LPs and raising an institutional fund is as hard as the founder raising their own, seed, Series A, etc. And you've not only had you've done both hats of being an angel investor, and you have like over 10, 15 companies in your personal portfolio, as well as now switching and raising an institutional fund, right? Take us through what last year was like for you, some of those, ups, downs, highs, lows, and would also love to hear a story from your own portfolio as well, similar to how Vinay shared the story of Bharat Pay with us. Yeah.
Yeah. Absolutely. I think last year has been challenging for everyone, and it's no different for us either. I would say that raising, especially for an emerging fund manager, this was our first fund. In terms of the investment and the track record, we had the angel portfolio to showcase, but there's no fund 1, 2, or 3 to really showcase to the institutional LPs. And it's extremely challenging because you're not just sort of educating them on Eximius, but also a lot of the pockets that we reached out to, we were educating them on the startup ecosystem overall. So I would say that raising for an emerging fund manager is very similar to raising a seed round versus a Series A. Because at the seed round, what you're showcasing is your vision, where you want to be, what you can do, and then walking them through that. So the way we sort of went about it is we knew that there are 2 pockets of capital or 2 pockets of LPs. One are the institutional LPs, and we have seen that there has been a lot of influx of institutional capital that has started to come to India. And that's primarily because of the cost of capital arbitrage. Debt costs are very low globally, even in India. But at the same time, the pocket that we went after was the newer pocket of capital that was coming up. There are also a lot of business families, a lot of HNIs, as well as old business houses in India that were wanting to get into this sector, wanted to understand a little bit more about this sector, but couldn't necessarily access institutional capital. So we really honed on that. And so that's where, my point that we knew that they're not just looking for capital for return, but in addition to that, also want to understand a little bit more about this sector. What is it to invest in a startup? How to start angel investing or how to start investing? How do you pick the right kind of startups? So we really started with educating our LPs around the startup ecosystem and then slowly sort of doing this. So for us, the relationship building aspect started way back when I was in London. In fact, I came down for 2 months in 2018 to sort of get started, understand a little bit more about the sentiment, spent 2 months in Bombay completely. But things were pretty grim around April to June of last year when the capital that we thought we had started to evaporate and we didn't really know if we were going to get it until September. It was in September that a lot of the investor sentiment has started to come back and we could see some light at the end of the tunnel and could make that through. So yeah, I think now going forward, since January, there has been a lot of capital and a lot of awareness. So for anyone who is thinking of being an emerging fund manager, I would say really go after that pocket and try to tap into that. In terms of portfolio company, to be honest, for us, a lot of our portfolio companies we invested in were accelerated by COVID. So very few of them were facing issues from a business perspective. However, having said that, everybody is sort of facing issues at a personal level. There are several companies that are today operating with 50% employee base, where one person is doing the work of 2, but people are really sticking through it. Especially right now, where sort of people are working late at night, early in the morning. We are also sort of going in and helping them out to the extent possible, getting on calls, sending emails. But yeah, I think just hoping that we can get through this wave. But in terms of resilience, everybody has showed quite a bit of grit and wanting to get through these times. Luckily for us, the investment period was a little bit driven by COVID. So we made sure that every single company we invested in had that COVID angle. Like how were they benefiting either from this process or could sustain themselves during this time?
Yeah. And Tushar, you have a great story with Multibashi, right? While they were at tech, they benefited greatly from the entire shift to online, but behind the scenes, it was indeed a pivot as well into live learning. Would be great if you could take us through that example of sheer great founder resilience and like the team coming together brilliantly to benefit from this shift last year.
Sure. So as all of us know, like last year was a inflection point for education and technology business, right? So Multibhashi also sort of leveraged it to their advantage. They were largely a self-learning focused English learning app, and they were leveraging the network of these educated women who could spend time on their application to teach languages to their users. Uh, so during the COVID time, they sort of pivoted their model into live learning and group classes. This was sort of a boom, and they discovered several new segments also in terms of the user base that they can target to. So that earlier they were largely focused on blue-collared employees and adults for language learning. During COVID time, they started focusing on kids segment. They started focusing on foreign languages. So in general, they saw remarkable numbers, right? For the app, which had huge engagement and user base. They now started seeing monetization. So their MRR went 15 times, their ARPU went 3 times, their course completion rates went to 99%. So overall, it was sort of a great period for them, a rediscovery of sorts, and they sort of quite benefited from the inflection point in edtech.
Yeah.
You're using the word inflection point. So Multibhashi is our portfolio company as well.
Correct.
So
Yeah.
she and
Yeah.
are doing well. Yeah.
Amazing. Just want to pop in a question about being sector focused and sector led versus sector agnostic. And I think one thing that comes with being structured and organized as an angel syndicate is flexibility. I believe in terms of not just ticket sizes and taps, but also the fact that you could stretch your thesis around sectors and potentially also lend capital to businesses that maybe might miss the traditional VC, especially the non-tech kind of sectors. So very quickly from both, Tushar, you can go first and then we go to Vinay. If that indeed holds true, or do you also very similar to WaterBridge, like how we actually publish the 6 sectors that we are focused on? Would keen to understand if you have certain preferences and why have you chosen to remain sector agnostic?
Yeah. So Anjali, I think honestly it's a choice, and it also depends on your strengths, right? If you have deep domain expertise in a particular segment in venture, where you can build a very solid and deep thesis in that particular segment, then you can choose the approach of being very sector specific, right? But I tend to believe that at an angel stage or at an early stage at which we are entering, we have to be a bit more flexible, because a lot of times you're coming across ventures which you would have not even dreamt about, right? So by just having a very constrained sector specific thesis, you may sometimes tend to miss opportunities, right? And for us, we as a syndicate can act fast. We are not constrained of choosing very sector specific thesis. So we keep on revisiting our notes when we come across good companies. We sort of revisit our thesis and keep on building that, right? So from that aspect, we are sector agnostic. But of course, if there are certain sectors which we don't understand well at all, right? It could be deep technology, it could be some very new upcoming segments. So until and unless we get an expert in a network to vouch for a particular venture, we would tend to stay away from those kind of segments, right? So yeah, that's our approach.
Sure.
Vinay, your thoughts? Yeah.
Sure. I think Inflection Point Ventures always has said that everybody can grow with startups, and therefore the whole theme has been everybody and everyone. And Warren Buffett has said that if you need a great partner to chat with, why restrict to a certain geography, certain color, and a certain day of the week, right? Be open to be able to attract the right partner. The reason why we went sector agnostic and then how we went, I think both pieces are important, as Tushar also said. One was we always went after an investor focused approach, which means where can we get the best IRR for our investors, right? Now that can be determined by going after great businesses run by great founders, right? So if we can find any business which is great, can make good returns and is run by a great management team, that's a great business to go after to make a great IRR. But the problem there is, how do you define what's great, right? Who helps you define what's great? And therefore, that was the crux of the problem to solve. For us, that got solved by our CXO network. We are the only network probably globally or an angel which has a Salesforce tools implemented at the back end where we know the data on everybody. Every activity is tracked. And we are able to very sharply determine which investor has what expertise and who can help where and how he can help us do our due diligence. Within minutes, our due diligence team is ready as soon as we get the data. Second, we have a large database of which VC looks at what sector, what check size, and what stage. The moment we invest in a startup, we know who are our target VCs also. So this bundle of knowledge, bundle of expertise, I would say a sea of expertise, allowed us to solve for being able to look at every sector properly. And that's how we have very wide inner sector portfolio today. And that's what has enabled us to do far more number of investments at a far more higher speed and build for scale. So hopefully that gives you a sense of why we do what we do, and then how do we enable what we want to do.
Got it. And I think, Paul, on the other side, which is the side that the two of us are on in terms of an institutional VC setup, we do definitely have to have sector theses. But more importantly, my question is around how do you kind of decide capital allocation between, say, seed deals, pre-series A deals, and secondly, between your first check versus follow-on capital. So typically, what kind of reserve and follow-on capital are you budgeting for or planning for? Yeah.
Now, that's a great question. So we primarily like to be the first institutional capital that comes in on any cap table. So ideally, when we speak to a founder, either they have just set up a company in the last 6 months or so and have, other than the founders, there is nobody else on the cap table, or they might have a few family and friends, angels on the cap table when we come in. So we are the first institution that come in. The way we have thought about it is we have allocated 50% of the capital for more exploratory investments in nature, which are around $150,000 to $300,000 that we invest across, or we plan to invest across 25 to 30 companies. And then the remaining 50% is what we call a little more exploitative capital in nature, where we will choose about 9 to 10 companies out of this portfolio that are doing well and double down on them up to Series A. So we'll sort of follow up and, if possible, double down in pre-Series A and Series A. We, on an opportunistic basis, could go to pre-Series A right away as well, if there is a thesis, but we ideally sort of like to stay very early on in a founder's journey, because that's where we think we can add value.
Got it. Awesome. I'm just going to start taking in some questions from the audience as well. So once again, do start putting it into the chat box, and please do try to prevent direct messaging me. I can barely manage one screen, let alone two. But there's a question for Vinay, so I'll throw that over to you, and maybe Tushar, you can add in as well on portfolio construction. Again, with VCs, especially like ours, we kind of very publicly state that we will not do competing investments. So if you already have, like, say, a vernacular doubt solving app, we would not be taking on another one. But I'm aware that you have much larger portfolios and syndicates work differently. So would love to get your views, Vinay, on portfolio construction and taking on competitive bets, not just direct competition, but if I could encourage you to take a step back, and even if the TOMs and TAMs kind of overlap, will you still go ahead and consider that opportunity?
Sure, we do. And that's our stated approach. And here is how we think about it. You may find it different, but here is how we plan about it. Let's say you have 2 kids, right? Will you, first of all, not have the second kid because you have one? Or will you not educate the second because you have educated the first and both are going to compete, right? You don't do that. We treat our startups and their founders like our own kids. And that's how we behave. And that's how they behave also, right? They'll go and break some law somewhere. They'll go and break some rule somewhere. They won't know what maturity means. They will not know how to deal with people. They'll fire somebody and then hire somebody. They do all kinds of, scary things. But just like our kids, they are far better in handling technology. They know how to manage remote. They know how to manage your TV better. I don't even know how to use my iPhone better, right? They know it. So that's where I think the best piece comes in. you work with them to develop them to their potential, where they can go, even they might be competing. Let me take a few examples. We did, let's say, a Fritzo and a Sportido, right? Both competed to an extent, but both of them collaborated as well. Both of them collaborate very well. We did a drawer and let's say a Suke. Both of them, one was good on software, the other was good on hardware. During pandemic, both of them went together. We did a GeoIQ and a Suke also. The GeoIQ and Suke partnered in these times of COVID to go to the customers, and great results. Bigger deals, we cut a $2 million check for Milk Basket, right? And then we cut a $3 million check for OTP. Very similar domain in the same geography as well, but very different founders, very different ways of working, and very different ways of attacking the market. And we very clearly defined what these guys are planning to do, and we backed both. Both gave good results, right? Milk Basket, I was the first check 2016, and 5 years later, a great company that we built. OTP first check went in a year back, and a great company built out now. So yeah, we do take competitive bets, but we treat them like our kids, but we identify their specific journey, their specific goal, and we help them achieve it. So that's how we think about competitive bets.
And Vinay, if I could just peel a few more layers and ask you a follow-on question in terms of would a founder be given a choice, for example, in having could you help build internal Chinese walls and have separate, say, set of advisors or set of CXOs that participate? Is that sort of customization available on the IPV platform?
Yes. So we allow the founder to choose who he wants in and who he not. You do share that, okay, these people are there on, let's say, Milk Basket. Do you want them on OTP as well or not? And similarly, people advising these two companies, can be different. So those pieces are in place, but I'll still leave you with the question. If you have investment in Unilever, will you not invest in P&G? Something to think about at an individual level, right? And if a consultant is working with Unilever, will you not work with P&G? I think everybody has their own journey to take, and I think people should help them, the founder, in their journey in what they want to achieve.
Yeah, and I'm just going to pick out a question from Nalina Balakrishnan here and kind of summarize it for Tushar or Paul, any of you who want to take this. In terms of, it seems like investors are doing everything and not founders, but the way I'd like to position that as a question is, what do you fundamentally believe? I know there's no right or wrong to this, but is it the hands-off, need-based, passive, kind of approach? Or are you the kinds of investors who have like literally weekly or maybe even like daily stand-ups? So who would love to know what your value add style and approach is. Yeah, Pearl, you could go first.
Yeah, sure. So I would say we are definitely in the middle. We don't do daily and weekly calls. We will catch up with them monthly or every now and then when they would like to. So the way we think about it is that we would want to have a set of value adds and services that we can provide to the founders, but we do understand that it's the founder who's in the driving seat, and each and every founder comes with a different journey and their vision is also different. So we don't want to make it very structured where we tell them exactly what path they should take forward, but rather one, ask the right questions, which we think is very important as an investor, is to actually ask the right questions and help them introspect and find the right answers to those. And then the second thing that we do is, of course, sort of have our value adds, whether it is from compliance perspective, HR and talent acquisition help, or fundraising help, have that ready for them and provide it to them so that they can utilize it as it fits their business and their thesis. But we definitely don't do a very sort of overwhelming holding them through each and every bits, because we do understand what makes them really unique is the founder and the founding team and their vision, and what makes them successful is also that. Otherwise we could have started 30 companies on our own. So we very much value it.
Yeah, I always joke that if, Antonina's response would be, if investors were as smart as founders, then we'd be founders ourselves. So I think, just the light side to that. And I think there's another question, which is, I think, a good one. We spoke about sector focus and sector theses, but just especially on the consumer side, as we look at India and this, with the cred ads going viral, we have this analogy about the top 10% and then the NHP or the next $500 million, right? Do you take slices that way? And even at WaterBridge, we have some of our recent investments are increasingly in the, the NHP, as we call it, which are around voice, vernacular, the tier 2 and Bharat kind of place where it's extremely high volumes, engagement, but there's still definitely questions around ability to pay and the revenue scale that some of these companies can achieve. But would love to go around the table and get each of your views on, what's your thesis around the top 10%, where it's probably the Sec A top 10 cities that are roughly at 100 million population, but 2.5 times the national average GDP, versus NHP. Tushar, we can start with you.
Yeah, so Anjali, I think we take bets across the segments. It totally depends on what the problem that is being solved by the venture, right? If it's a problem which is a big pain point for even bottom of pyramid, right, there is a potential to make revenue. And considering the volumes that are there existing in Bharat and next billion consumers, I think there is enough potential to make money out there. It totally depends on whether you understand that segment or not, and are you really solving a problem for that particular segment or not, right? So that's our approach. In fact, we are increasingly getting excited about digitization of Bharat and how because of COVID and otherwise because of digital transformation of India, we are seeing a lot of people now using their smartphones for making purchases or for moving behind just content consumption towards transaction. So yeah, we are fairly excited about what I say bottom of pyramid, and we are also in fact more excited about the top 10%. And in fact, it is increasingly difficult to build a business just for them, because as Indians we tend to think in numbers, and but the value of course is immense in the top 10% as well. Yeah.
And Vinay, what's largely been the GTM for the B2C companies that you've closely watched across your portfolio? Do they typically start from the top and make their way, to the median, or do you believe like the top 10% of these 100 million Indians living in these top 10 cities is a large addressable market in itself?
So it depends, Anjali, what kind of product and what kind of value prop you're giving. So some of the D2C companies, they go top down, right? I mean, we invested in Happy Jars, we invested in Samosa Party, we invested in Tea Monk, OTP, Milk Basket, etc. So where the consumer has that need, the consumer can pay, consumer values convenience, consumer has the infrastructure to order, and so on and so forth, right? In the end of the day, if that's kind of audience, then you go after those. But then there are others which you go after in the bottom of the pyramid as well. The key here for us is whatever the startup is defining as the TG, is that TG happy? Or let me put it more clearly, are they deriving value out of it? And for us, we think consumers need 5 things. They need a great cost-effective solution. They need a far better quality. They need very high speed compared to what they are right now. They need a good customer service, and they need a good sales relationship, right? So versus what they have today, right? If these 5 combinations can be improved by 10x, we'll take the bet, whether it is top of the pyramid or bottom of the pyramid.
Yep, got it. Great. And Pearl, to just throw the next question your way. And I'm just going to combine a few questions, folks, if you don't mind, also keeping track of time that we're down to the last segment in 15 minutes. So do punch in as many questions as possible. I think, Pearl, there are questions around considering the fact that early stage investing, by definition is early stage, mostly pre-revenue companies, and especially on the consumer side, what's the evaluation lens, and what are maybe the top 3-5 indicators / metrics that you look for as you evaluate pre-revenue companies?
Okay. So I think in terms of metrics, they definitely differ from sector to sector, as well as the kind of company that we are looking at. But what we focus most on is the team and the founding team. And this is something we tell within the team as well as to the founders as well, that the stage at which we come in, we know that certain things will change. In fact, quite a few things will change along the way. But one thing that stays the same is the founding team and their conviction towards what they are building. So we spent a lot of time getting to know them, how they think, their thinking process, how deep they go into a problem. Are they just sort of trying to solve a problem at the surface level, or are they sort of peeling in a lot and trying to really dig through the consumer sentiment, what the consumer wants, and trying to solve it at that level? So once we know that a team understands the consumer at that level, we know that even if it's not the right product right now, they will pivot to the best possible outcome. So we sort of build a conviction around that. But of course, we also, because we are VCs and we look for large outcomes, we also focus on the market. We want to make sure that it's a large enough market where a decent market share can be captured. And it's definitely a plus for us if there is an MVP that has some early validation from the market. If there are some consumer sentiments that we can back on the basis of, that's definitely a plus, but not needed for us. So it's a founding team that ultimately we are betting on.
Yep. No, likewise, I think at WaterBridge, I always say we put founders ahead of markets. So we strongly believe, or I would say that we really like founders of either solve the problem or experience the problem themselves in a previous avatar. It could be as a student, it could be as a professional, that's secondary, or somebody who's experienced the problem firsthand, maybe even as a consumer. So I think that vantage point is kind of important as you set out to build a differentiated product. And just questions also following on, typically in terms of just founder background. And, Tushar, if you could take that one. I think there are questions around, there are biases against, say, single founder versus multi-founding teams, tenured professional founders versus, say, fresh out of college founders. But how does a founder kind of best position himself for success? And we do know from data that, I think, it's only 50% of the companies that raise more than $1 million, and just 80% raise more than less than 20%. Raise more than 10 mil. So how do kind of founders position themselves? And if you are a single founder, how do you build a co-founding team or a set of strong early employees to complement your skill set?
Yeah. So Anjali, we'll have to understand, why do these rules exist, right? So why do investors say that we want more than one founder in the founding team? I think the thought process behind that is that each of us know that entrepreneurship is a very tough journey, right? And investors are looking at teams which have complementary skills, which can enable success of those particular ventures, right? But as an investor, I tend to keep on asking myself all these questions from counterintuitive point of view. Are we missing something by not backing, married co-founders, or by not backing single founding founders, right? So at the end of the day, as an investor, what we are trying to gauge is how strong a team you have today and how strong a team you can build in future, right? How strong a team you have today can be assessed by talking to founders and the senior management team. How strong a team you can build in future is assessed by the ability or the charisma you have to recruit, rock stars in your team. So I think that's the sort of thought process with which investors look at founding teams. Of course, if you feel that you are a founder who's only strong in a particular skill set, it makes sense to look out for co-founders who can bring complementary skills on your team, or in fact have a strong ESOP pool of, let's say, 15-20% even, if you're just a single founder, to attract senior talent who can bring complementary skills on the table.
No, well said. And I'm just going to take the next question to Vinay, since this is around deep tech. I think a very valid question asked is, early stage deep tech. We've answered the pre-revenue part, and in deep tech, you tend to get into this research trap, if I may, where you keep kind of trying to double down on your product and wondering whether you've hit MVP and when are you going to actually commercialize. So how do founders firstly become self-aware that they are even in this trap. And a second part of that question is how important is filing patents, IP protection specific in the Indian context, where we know, the regulatory challenges and the legal framework not being that strong.
Sure. I think 2 or 3 points here. At IPV, we follow 3 pillars of investing, right? One is a great business run by great founders, and then the right investing psychology, which is the toughest part, really. The business is easy because it's hard numbers. You can figure it out. Founders is difficult because it's an art. You need to know the human psychology to be able to bet on the right founder. But even harder is to know yourself, right? Whether to take the bet or not. Let's say you've got a good business, good founder. The difficult part is how much do you take the bet on, when do you take, and whether do you take the bet or not, right? So deep tech kind of comes into the third category. You don't know the business. It's pre-revenue, pre-product. You kind of have a sense of the founder, but you can't evaluate because he's not delivered anything yet. And then, now the question is up to you. Do you believe in the guy? Do you believe in the problem? There are 2 or 3 pieces which we look at. One is that deep tech product going to solve a big problem, right? And that problem has to be really big. And therefore that deep tech is something that enables solving a problem which could not be solved earlier. For example, let's say Google Maps. Without Google Maps, you cannot have an Uber and an Ola running, right? Because that's the underlying infrastructure for enabling these technologies. Or a Paytm technology to transfer 2 rupees. Earlier, the cost of banking or transferring 2 rupees would be 200 rupees. So, it's ineffective, right? So if you are coming up with these technologies, which can do something which was not done earlier, to us, that's deep tech. It should solve a big problem. Now, recently we were evaluating a startup where you could make melanin, which colors your skin, but has a huge ultraviolet protection properties. And this startup, if they can, cut the cost by 1/10 or 1/20th, suddenly it becomes a far more lucrative. And therefore, what you need to look at is, are these guys going to solve a real big human problem? If they are, and if they are good founders, and if the SMEs are telling you that this is something doable, you can take the bet by building in your margin of safety. Coming to IPs and patents, I think they're very important. May not be very, very early on, but as they start to build traction and scale, and as they have the funding, because IP and patents can be a very expensive process, especially in the domain of pharma, etc., in the US, for which they would need funding, but that remains important. And at IPV, we've had some good success. We cut the first check to So Strong, which was in e-gaming, and that was 2 years back. And last year, it got acquired by Dream11. It gave a great return to us, but because we were solving a problem that Dream11 wanted to add. Similarly, Fitso went to Zomato, solving a bigger problem for all the eaters and the couch potatoes to go and exercise. And similarly, I think we had one more, which went to a strategic buyer, which I can't disclose. But again, a very deep tech problem being solved, which a large buyer could not innovate on. So problem focus is critical in any deep tech area.
I think since you brought up Zomato, it's good to mention, one of the happier news of today was the fact that they did file their IPO. It's been a good day for both B2C as well as B2B with, I hope the Freshworks news is true as well, that they're appointed bankers and are on their way to their IPO as well. But there was a question, the reason I mentioned this, there is a question around large scalable opportunities and why do VCs only chase, why do we always say venture scale opportunities? And the reason is this, that we are, end of the day, funds. We raise money from institutions. It could be angels, it could be HNIs, it could be family offices, pension funds. So it's some old lady sitting in Canada whose teacher pension fund is coming into us, and there is an obligation to return capital. So I think that raising if you think raising capital is hard, then returning capital is even harder. And there are exit obligations, and therefore it's important to kind of see if an opportunity can return capital as well, as Vinay gave some examples from his own portfolio within a defined time frame. And I hope that kind of answers the question around social versus commercial outcomes and the kind of businesses VCs tend to fund. I think there's another question which maybe, Tushar, Vinay, you could take that. It's more relevant to you folks in terms of what would you advise a founder in terms of mentor equity to hand out to, say, your early mentors, advisors, etc. And is that a model that you encourage at all, or just what's your advice for founders? And Pearl, you could also have a point of view towards the end as a VC. How would you perceive, what allocation are you comfortable with for mentor and advisory SOPs?
Yeah, so I'll take that first. I think if you're getting very, very strong advisors on board, we wouldn't mind if, let's say, 3 to 4 to 5% of the company is going to them, right? But it should be a bunch of advisors. Anybody having free equity, which is more than 2% of a company at an angel stage, sorts of doesn't look, acceptable to us.
Vinay?
Sure. See, I think as Tushar said, I kind of agree with him. I think that mentorship equity should be very clearly aligned to the goals that you will help the startup achieve, and ideally should be proportionately linked to those goals, right? Now, I mean, we are a bunch of CXOs here, and we bring in a very high level of expertise onto the cap table. But we are also very clear that if these 10 people's cost was to be available to this startup, that will be very expensive, right? So what we do is we bring these people in from our expertise set of pool and say, okay, can you give us time, right? Because, we also follow a Brahma, Vishnu, Mahesh approach. These are our internal ways of working, where we say a Brahma is the knowledge, harbinger of knowledge, and therefore his wife needs to be Saraswati, which is, the knowledge owner. And then we say we need a Vishnu who is the operator of the word, right? But he needs Lakshmi behind him, which is the resources to operate the word, right? So for us, founders act largely as operators and, get stuff done, but also bring in a lot of knowledge part that needs to come in. And to us, both are important. So if we are bringing in those guys, let it be very, very sharp, very, very target driven, and far lower than they would have charged otherwise, right? So yeah, I agree. Anything beyond maybe 2% for a bunch of advisors together, I think doesn't hold good for founders' long-term success. But up to 1 to 2% with very clearly defined milestones and goals, I think is acceptable.
Yep, I think anything more than that would bring Maheshwara into the equation, but I'm glad you didn't mention Shiva. Yeah, but Pearl, there was also a follow-on question as how do an institutional VC who comes in maybe after an angel syndicate, how would you view a significant advisory pool? Yeah.
So I think I sort of more or less agree with Tushar and Vinay that but we are also a little more prudent on that side. We definitely ask founders to evaluate before giving out any equity. In our view, any equity that is given out, it's not like capital. It cannot be redeemed. It's sort of given out for good, whether you are a $10 million company or a $100 million company. So founders should really sort of sit down, and it cannot be taken back either. So they should really sort of sit down and evaluate why they require a particular mentor on board and why they need to give out equity to have this particular mentor on board. We've also come across company where we see ridiculous numbers like 10%, 15% given out to angels in the early stage. And this is primarily, for very small capital, primarily mentor equity. We would say that if it's absolutely required, founders should sort of stick with that 1.5% range. But definitely before that, be a bit more prudent, keep your equity close to you, really evaluate why it's being given out, what are the objectives that can be achieved, and why this objective cannot be achieved with the capital that they have, and why they can't raise the capital for this. If they can raise capital at a higher valuation and can dilute less, then why not do that and actually hire the mentor rather than having to give out equity? So once a founder really evaluates all these options available, if they can tell us exactly why it was given out, we get comfortable with it. But we definitely at our end discourage that because we think that founders who are in it for the long run have been giving their 100 to 100% are the ones that should be on the cap table with, of course, the early employees and some of the key founding team.
Awesome. I think that's a lovely wrap to this session. It's like on dot 5 p.m. So thank you so much, Tushar, Vinay, and Pearl, for giving us your time. And I think right now we all need to head to the COVID app and book our slots for the vaccination. So I think that's the critical next step for each of us to do, if the app has not already crashed, that is. And thank you so much once again. For those of you who are continuing, we've answered as many questions as possible. But if you've missed or we've inadvertently missed answering any questions, we do this every Wednesday. So please join us again next Wednesday to meet another set of fantastic investors, and we'll try to get your questions in. But thank you once again, everyone. Stay safe, stay indoors, and go register for that vaccine. No excuses beginning today. Thanks, everyone.
Thank you.
Thanks, everyone.
Thank you.
Tushar.
Thank you, Anjali. So if I could just have everybody staying back for about 2 minutes. So I've just shared a link in the chat in which you can share your inputs about the session and anything you feel went well or didn't go so well. Not only that, you will also be able to see the recording of the session that has just concluded. And you can also find a tab wherein you can connect with all of these investors separately. So we really encourage you to go and let us know what you thought about it and make full use of these features. The link is in the chat. And feel free to ask us in case you have any questions.
We see a lot of familiar faces. Hi, Ravi. Hi, Priya, Darshi. Good to see you guys here. Thank you for joining. Rekha, good evening. I also see Sony, who's a founder. He's from Kerala. And Surya, thank you so much for joining in. We have been doing a lot of work together in the past. Hope to continue. Hi, Abdul. I see a lot of founders are there from the founders feed, from our TiE members as well. Thank you, Venkat, also for joining in. Vinay, have we shared all the details of how they can follow us, if they want to subscribe to our newsletters? And I also see that Gauss is here from the Sayadri College. Good evening, Gauss. You should share about the internships that is possible for IoT ML sessions. Thank you, Rajesh. Thank you for your kind words.
So I see Himanshu has raised his hand. So Himanshu.
Himanshu, you can come and say hi to us, please.
Hi, I'm Himanshu. I have a question. So we're a technology company and we are at a product stage where product is undergoing final user trial. We've been able to bootstrap. One of the challenge while I was listening, one of the key challenges that we are facing right now from a seed stage investor is that you're looking at a too large a problem to be solved. So how do we address that at a seed stage investment scenario?
It is your ability to show the vision to the startups that matter. At some point of time, you're going to be growing, you're going to be doing really well, your addressable market is massive, your team is fantastic, your vote is brilliant, and the moat is so strong that even if there is competition, which you understand and identify, you're still able to crack it. And if you're still not able to convince this one set of investors, it's time to move on to the next set. The world is full of investors hungry to invest in the finest founding teams. So reach out to more and more, expand your network, Himanshu.
Sure.
You must expand your network. And also remember that even as you're talking to investors, you must also focus on your product. You must focus on traction, etc., because that's what will make them feel that, oh, these guys are growing. This is a great team and we must back them.
Sure. Thanks.
Right? Not a Gyan, I'm not giving a Gyan answer, but that's the best way to do it. Okay.
In fact, in yesterday's session, they spoke about, the best money is customer money. So when you keep getting customer money, everybody's impressed and they want to be a part of your journey.
Yeah, they'll knock on your doors. Yeah, you start showing that you have contracts. You start showing that you have a lot of traction, and your product also is getting better and better. And as Vinay said, customer money. You have customers giving you advances, signing up with you. The actual MOUs and contracts are there, money hitting your account. That's what excites investors. Okay.
So we have Shama Sundar, who also
Hey,
wants
Shah.
to.
Yeah, please. There are plenty of people. You can please feel free to say hi.
Hello, yeah, I am Shama here. Thank you very much. Very good, fantastic session. I'm also the MD of Utkarsh Kaushalya Foundation, where we have a group of advisors as well, and it's a startup, and it's a foundation and a not-for-profit organization. We're just trying to see how we can go ahead, inculcating the skill development of the new startups and the other SAXO level of the people, and how can we be guided by TiE Bangalore or Bridge or any of these organizations? Please help us.
See, we are a platform and a community. Okay. So what I would like you to kind of tell you is that see, we will provide you all these kind of platforms. Okay. And we are a membership driven organization. We do a lot of sessions which are strictly only for our members. Okay. Where you can interact with our other charter members and other members through mixers, etc., etc. You don't necessarily have to be from Karnataka or Bangalore. Okay. So this is some of the things that I can say, that we'll give opportunity and platforms like this. I mean, no one else gives this kind of thing where you can come in, you can talk, you can share about yourself on the chat, you can interact with the 100+ people who have come in. So this is what we can do. We don't endorse, we don't recommend, okay, because we are neutral. And what really matters is we give you an opportunity to network, educate, build your knowledge, say hello to as many people as possible.
Thank you so much.
Most welcome, sir. Please, guys, we'll stay open for a few more minutes. You all must come and say hello. Let the world know we have more than 60 people even now here. It's a great opportunity.
Vijeta, some of them might be feeling a little shy to unmute their mics, but we would still love to hear from you, at least on the link. Absolutely. You can give us your feedback in writing and also connect with all the investors and more that you saw and listened to today. You'll also find the entire recording of today's session. So a lot of you were messaging me about that. So definitely check the link out. I'll put it once again in the chat. So let us know what you thought about it and how we can improve.
Okay, great. If anyone, we still have maybe a couple of more minutes, few more minutes. If anyone wants to say hi.
Hi, Vijay.
Yes. Hey, Rajesh.
Thank you.
Thank you.
I think I'm getting echo. Can you hear me?
Yeah, we can hear you, sir.
Yeah. It was a wonderful session. And this is one session which I have in my calendar. I don't miss single time. And I have a question. This is the first time I'm going to this crowdproduct.com link where it is showing investors connect, right? What happens when we give a connection?
Sir, nothing happens, sir. It's up to you. We bring these investors here into our community, into our platform. At the beginning of the session, also all their LinkedIn profiles, you're most welcome to reach out to them, talk to them, etc., etc. Okay. So as I said, we don't endorse, we don't recommend, we don't invest. Okay, but we enable more and more aspects of people to get to talk to each other and know each other.
Yeah. So we basically collecting your inputs that we can put across to the TiE leadership and the speakers. Sure. So based on your feedback inputs, we put it across to them.
Thank you.
Hi, Vijeta. Hi, my name is Montek. Vijeta, I just want to understand from you as to how do you see this whole mobility space growing with electric vehicles? I mean, is there you or anyone who's as wise as you can definitely
so definitely not wise, but we have a lot of charter members like Ravi Kiran, who's from University. Okay, he's very much into that, and they're growing a lot. So EV space is also about the work is happening on charging stations, government policies, manufacturing, getting better and better batteries, etc., etc. Number one. Number two, you should Vinay and team, if you can share about the Iot Forum, the Telegram group.
Yeah.
So we have a very, very active Iot Forum. So one of the 6 and focus areas is about EV. Okay, two-wheeler charging stations And as you know, there are companies like Ola that are planning in the month of June, July to bring in millions and millions of these vehicles. Yulu is there. So EV is a big one, and it definitely is going to be a focused area for urban mobility, etc., etc. So it's again about what do you have to offer, like what are you going to do about it? How are you going to attract whether customers or investment or partnerships? I think that's what matters. It's getting to be a very, very crowded space as well. Okay, there are
Right.
so many companies right now. Right from the top end, right? You have Ether Energy, which is selling 1.5 lakh rupee two-wheelers to people, like electric bikes are there. Then you have the shared mobility, which is led by Yulu. Okay, so there's a
Right.
lot of things happening in that space. Opportunities are massive, and you can follow all the updates that we put out in IoT Forum as well. And there are a lot of subject matter experts over there.
Right. Right.
Thanks,
But how important do you think data is? I mean, like, even if you look at Tesla, if you look at Facebook, if you look at
Data is
Amazon.
everything. Yeah, without data, nothing can move forward. No. So if you see, there are so many companies that are like IntelliCar, etc., etc. They are the pioneers because they are providing the data for how you can improve your vehicle, how can you make the consumer, customer experience, user experience much better. Like for example, you're having an electric vehicle, you need to know, right? Like how much charge do you have, where is the closest charging station, etc., etc., etc. Right? How do you optimize the use so that you don't die of charge in between?
Right.
So there's a lot of data points, etc., etc., that is being used. And this is also data points that is being collected by the government, by manufacturers, by all the top-notch people in the charging station facility also that is going to grow like crazy. Okay. Yeah. So data plays a very important role. So if you don't have to be a manufacturer or a EV charging station company, but if you are into someone who's into analytics, can provide and work with all these people, there's a massive opportunity there also, Monty.
Right. Right. Thanks.
You're
Thanks,
welcome.
Vijay.
So we have shared a bit
Hi,
about
Vijay, this is Ravi here.
Yeah, hi.
Hi, fantastic session. I think, like I put in my comment window, I started as a single founder company way back in struggled quite a bit before wrapping up in 2000. I spent 7 years there, but I could hear a lot of advice on single founder companies, deep tech, all of them deep tech. It's exciting to see that the world is changing. And thank you very much. I look forward to engaging with the investor community. Right now, we are all into medical imaging analytics, but medical imaging analytics with healthcare is a huge opportunity that we see. And IoT or wearables with analysis is where it's going to go. So yeah, the care continuum is what we are looking to see, and then want to see covered in the in the upcoming shows, because that's one area where I think lot of real life difference can be made in India, given our poor healthcare system per se. So any thoughts on that? And from the investors?
Yeah, definitely, Ravi. So, I mean, there is now, because of course, health tech, med tech will definitely see a lot of focus up because of the current situation that we are in, right? If you see that many of the companies at like TiE Ventures, if you recently read, has raised their second round, they have invested in multiple companies like Nirmay, etc., etc. Okay.
Right.
So 100% you're going to see interest, but obviously there is so much of what should I say? I would not say competition, but there are many startups for them to choose from. Right.
Right.
And they will definitely 100% look at whoever has got a strong team, a deep moat, and is addressing a very strong market of customers who are willing to pay. So I think that's something that we have to be a little bit careful about, right? Because as a startup, you need to make money.
Correct.
Yeah. So that question, if you can address to the investors, because ultimately they want to exit, ultimately they want to make money. So if that part gets sorted out and you show the clear vision, then the sky is the limit, Ravi Saab. The sky is definitely the limit. There's so much of opportunity.
Fantastic. Thank you very much.
No problem, Ravi. Pleasure.
Hi, Manu here from Bangalore.
Hi, Manu.
Yeah. So basically, we have a startup where we are into military simulation, firearm simulations.
Okay.
Our equipments are mainly we have developed such a sophisticated technology right now, which is very unique in India, which allows people to play PUBG in real life. So that is one segment. And second segment is the same technology with the different equipments can be used in military for battlefield simulations.
Okay.
So as this mentioned, this shows that we have two different platforms with one software and hardware. So at this kind of this view, or what will be the VC's point of view? Will they say go for both or go for one?
Sir, so I'm not a VC, so it will not be fair for me to comment. But if you see, what they really care about is how quickly and rapidly can you scale, and have you understood the industry so well that whatever the challenges or whatever the competition is or whatever the policy and regulation changes happen, you're able to still survive, you're still able to thrive, you're still able to grow. So definitely gaming is a very big industry, and it is actually so huge. No, I mean, if you see IPL also, half the sponsors, the biggest sponsor are gaming industries, correct? I mean, form this dream team, and then you'll also see that physical gaming also is going to become not now, but 3 months, 6 months, or whenever we come out of this, even that industry is going to grow huge.
Okay.
So gaming, we also have quite a few of our charter members and investors are there who are into this space, and it's growing tremendously, and a lot of collaborations and partnerships are happening. And because the policies and all that is changing, it's not seen as gambling anymore, correct?
Yes.
It's not seen as, I mean, that's the important part. It is seen as entertainment. It is seen as something that can educate. It is seen as something that will actually build your mental and whatever skills, etc., etc. And the gamification is also entering the education industry in a big way. All right, sports, education, and other things is where gaming is playing a big role. And if you are someone who is into that space, I think the VCs will 100% be interested in you, sir.
Okay. Okay. So is there any way I can get into the specific VCs who are into gaming and sports, or?
It's all available. You just have to look at, get into Google, and you do a search. Or best is you look at all these Dream 11, etc., who are the VCs who have invested in them, angels and VCs. Go back. I mean, you should always start from the beginning.
Yes.
First, there will be seed, there will be angels. Then you will have the next round of bigger investments, etc., etc.
Yes.
So you should, I think if you're someone who's starting up, you should not look at the big guys who have put in at Series A. You should go back. You should look at who are the seed, who are the angels, who are the first investors.
Yes.
Okay. That's what you should look at, because those are the people if you're a early stage startup, if that makes sense to you, sir.
Yes, it did. Yes, it did. Thank you very much.
You're most welcome, sir.
Yeah, hi Vijayata, how are you? Kaushik.
Hi. Hi Kaushik, how are you doing?
Hey, I'm good. As usual, great session. So, no words to describe it. So I think it was very helpful. So, just like to connect with you offline.
Yeah, sure, Kaushik. Anytime, man. Good to hear your voice. Okay, thank you.
And thanks. I just heard previously that Mr. Ravi, right? Ravi Chukula is also amazing in analytics. So I'm also into healthcare. So just like to connect offline.
You all should. See, one thing that we recommend, why we do this networking session is you all can put your LinkedIn profiles, your email IDs out there, so that each of your founders should talk to each other and and figure out how the industry is moving. So that's why we're doing this extra 15-20 minutes every time. Thanks to Vinay.
Happy to connect here, Vijayata.
Yeah.
This is Ravi here.
Yeah, hey, thanks, Ravi. Yeah. Just put your email IDs or LinkedIn profiles out there, so that whatever is, I mean, again, you can even do one-on-one, or you can put it on the group so that you guys can talk to each other. And many of us are part of common WhatsApp groups, the Telegram groups are there. So we would really encourage, the founders to talk to each other, and everything is possible.
Yeah, great.
Yeah, hey, thanks, man. Thanks, Ravi. Thanks, Kaushik.
Hey, thanks, Ravi. Thanks, Vijay. Bye.
Thanks, Kaushik. I look forward to me chatting with you.
Yeah. Okay, so I see even Kumar has shared his LinkedIn profile here. We have a few more minutes, guys. If anyone else wants to quickly come online and say hello to everyone, introduce themselves, etc. Hey, Kumar.
Hi, Mr. Vijayata.
Hi.
Shivam. Yes, hi. Shivam Kashyap here. So I had more like a follow-up question. I represent this alliance called India Energy Storage Alliance, and we work mostly on the electric vehicle and energy storage startups. I basically am taking a lead on basically mentoring very early stage startups who are from the EV space. So just wanted to ask you basically, how would you advise me on basically mentoring such early stage startups whose innovation is, is still not, let's say, up to the market requirements? How would you say we mold those early stage startups that will make sense to the VCs and the investor network?
See, what matters is you got to have your profile out there. You got to show your skill sets and why you are the right mentor for them. Okay. And I think that's the first stage, right? If you're publishing some nice thought leadership articles, if you have organized a lot of roundtables and sessions and bringing subject matter experts, and you have some success stories, etc., to talk about, I think that's the first step, and that's the way it will move forward.
Sure. Thank you. And you mentioned that TiE also had a separate exercise for the EVs as well. I heard that.
Yeah, we have. So part of the IoT forum and everything.
Sure.
Our charter members, etc., lead the. I mean, look, they're huge in the EV space. They run successful companies. They're investors, etc. So some of them are running this kind of special interest groups, which focuses on the startups. But okay, they don't. I mean, it's not really the consultants that they work with. They work on the startups, the enterprises who are potential customers, and they look at the investors who are willing to back the startups. So these three things are the focus areas, right? I mean, that's what TiE does. Like, how can we help them to grow? How can we help startups to get more and more customers? How can we help them to open up markets for them? And how can we help them to get the investment/funding? So that's what the focus, what TiE does, right?
Great. Would love to connect with you in person in a one-on-one discussion, maybe.
Oh, sure. Absolutely fine. Please go ahead.
Sure. Thank you. Thank you very much.
Thank you very much.
Really loving the sessions, and all the best.
Thank you. And for everyone, please do join in next Wednesday. Next 2 Wednesdays, we'll be having this. And then we'll be reworking some of the programs. We are trying to do more startup showcases. There are a lot of IoT forum activities that are lined up for next month. And yes, some of the closed door sessions are also there, but that is only strictly meant for members, because we do a lot of these focused activities for them to understand their pain points, because these are all startup entrepreneurs once again. And we do a lot of these ask me anythings. We do legal clinics, we do funding clinics, etc., but that is strictly meant for members, and that's closed door, so we don't talk about it much, because it's like all confidential stuff, because they don't want us to talk about it. But this is another opportunity for members that we give. All right. And plus, yeah, open house communities, all our IoT forum sessions like these, where all of you are most welcome to come, listen and share, say hello to each other. Okay. Thank you. Okay, it's 5:23. Is there anyone else?